a very good afternoon from me, Richard Banks. Welcome to this Euromoney live stream, the final one in our Saudi 2020 series. Before I start, I have to do that boring thing of reading our disclaimer. So this live stream is for information purposes only. We are not providing investment or transaction advice. All opinions are those of the presenter, guests and audience, and not of Euromoney. And all content is copyright Euromoney Institutional Investor PLC 2020. So as I said, we are approaching the end of a year I think none of us will ever forget. And we're also, as is traditional, approaching the time of year where Saudi Arabia issues its budget. We had hoped initially that the budget would be released a few days ago. Unfortunately, that's not the case. We have had the pre-budget announcement, so we have some idea about where the kingdom is looking at its forecast for next year. But anyway, after 3 months of Saudi series and a year that, as I say, none of us will forget, we thought it was a good time to take stock of the Saudi economy in 2020 and beyond. So in order to do that, I'm very pleased to welcome two friends of ours, each of whom has or knows more about the kingdom than almost anyone, and together have an unparalleled combination of insight and expertise, and are also two of the most entertaining speakers that I've had the privilege of working with. So it's a great pleasure to welcome, first of all, Ammar Alkhudairy, who is chairman of SAMBA Financial Group. Ammar, who's joining us from Riyadh. Ammar, welcome.
Thank you very much, Richard, for your kind introduction. Looking forward to this session.
You are very much so. It's always a pleasure to have you on a virtual panel anyway. Of course, the other person we're welcoming is Simon Williams, chief economist, Deep Red, Central and Eastern Europe, Middle East and Africa, otherwise known as CEMEA, from HSBC, who joins us from inside an HSBC logo. Simon, welcome. Good to have you here on the show.
Good afternoon, Richard, and thank you for recognizing the official gloomy grey 2020 backdrop, but there is a rainbow either side of my head because better days hopefully do lay ahead.
Is that a Brexit rainbow, or are the clouds the Brexit?
Let's just take it as a rainbow.
Very good. So welcome to both of you. And of course to you, our audience, who I can see are coming in at high speed. As always with these sessions, this is as much about you, our audience, as it is about us or our speakers. I very much want you to ask questions. Could you ask them in the Q&A, not the chat? Sometimes I can't see the chat. So if you see me sort of glancing away, it's not because I've got someone behind me, it's because I have the questions open. You can start asking questions now. If what you're asking is something we should answer immediately, we will, but there will be a more formal opportunity for audience questions later on. We're running for about 50 minutes or so, just before 2 o'clock London time. So that's your window. And as I say, please do use it, ask anything you want within reason. And we will endeavor to answer it if we can. So, jolly good. I'm going to start, Simon, with you. And I think what we want to look at to start with is this year, what this year might look like in terms of GDP and other key metric performances for the kingdom. And let me give you a little bit of a sort of picture as to how I've seen it. I mean, the year came into the year relatively well, pandemic hit, numbers were rapidly adjusted by people like the IMF quite significantly downwards. But it appears from the numbers that I've seen that what we were thinking might be happening in August, i.e. a really severe contraction, that Saudi Arabia is perhaps doing a little better than we all thought it might, including the Saudis in the summer. Where do you sit on this? What's the house view?
I think that's fair. I mean, we've got a contraction for this year of something around 4 or 5 percent. That's roughly in pace the kind of contraction we're expecting for the global economy as a whole. And it feels like the worst of that downturn is already behind us. The high frequency indicators show not about normalization, but certainly some pickup in momentum over the second half of this year that hopefully continues into 2021. So we've got growth next year running around about 3.5 to 4%. So next year should feel materially better than this year has done. I think there are a couple of caveats, a couple of important piece of context to frame that view. First of all, be aware that the GDP numbers for this year do look a bit better than perhaps we've been expecting earlier in the year. You have to look at the composition of GDP, and particularly look at those Q2 numbers, which came out stronger than perhaps been anticipated. But that was because of that massive contraction in imports. If you look at domestic demand, that was down nearly 16% year on year in Q2. That's an unprecedented fall in GDP. As I say, I think we're past the low point of that, and the Q3, Q4 numbers do look stronger, but I think we're still a ways away from full normalization. One of the things that we track very closely is that Google mobility data, which gives you a real-time sense of where people are spending time. It's clearly off the lows, but we're not back at the position we were before COVID hit. And I guess my last observation would be to think not just about the shape of the recovery, the drop and the bounce back, but think about the level of GDP as well. And that's something we're doing globally and across the region. But I think it's particularly important for Saudi, because the kind of contraction we're expecting this year won't be fully reversed in 2021. So by the end of next year, GDP will still be smaller than it was in 2019. I think it's got implications for broad prosperity, what it means for investment, but also for some of the pressures that there are on the fiscal as well.
Mm-hmm. Well, there's a lot to unpack there, which we will do in a second. But I'd like to sort of get Ammar's top line perspective as well. I mean, you are, of the three of us, you are the one sitting in Riyadh. You see this day to day. You see the effect on the kingdom. What's your take on the economic performance this year?
Well, I'm glad you asked me today, not 6 months ago, because if you had asked me 6 months ago, I would have had egg on my face by now, because I really did, like Simon, we expected way worse performance than we had seen. I agree with him. It's somewhere between, 3 to 5%, call it 4 to 5, 3 to 5 is the contraction. If you had asked me in April or May, I would have said maybe double that. And I think even some of the, eminent global institutions were predicting that back then. I think it would be quite interesting to try to analyze why we were wrong. Fortunately, alhamdulillah, we were wrong, but what caused us to be off by this much? And I think a number of factors have caused the decline, have caused the Saudi economy to be more robust than we had feared, because it is more robust and more agile, albeit it's down, but for an economy that's enduring both COVID and a drop of oil revenue of 50%, we can't just look at the price of barrel. You have to look at the price of barrel times how many barrels. So we're down 50% on revenue and COVID, and to be 4 or 5% down, that's pretty robust and agile. And I would, if we want to talk about why that is, not in any particular order of importance, but I would like to just talk about three features or observations. One of them is housing. This year, through the various government programs which are executed by the Real Estate Development Fund, we're talking about some 225,000 houses. That's pretty close to 250,000 houses that will be purchased and occupied by new tenants. The ownership percentage in Saudi Arabia already beat the, I think, 2024, 2025 target. And I believe by end of next year, we might be beating the 2030, Vision 2030 target of home ownership. But the bottom line is nearly 250,000 houses have been sold. Most of them are new units. So you can imagine the complete cycle that it causes, from building materials to white and brown goods to furniture, you name it. So that's one reason for why I and people like Simon were might be a bit off of our projections. The other important reason, in my opinion, is women employment. We have, I don't have the latest data, but I would reckon probably 800,000 by now, women who have been employed. And most of those are a replacement of expats that used to live in Saudi Arabia. This has taken 3-4 years to happen. But if you do the math, the amount of money that becomes available for, local discretionary spending, because most of these ladies, most of their income is discretionary because of, social, the way the social fabric is built in Saudi Arabia. Women are not expected to necessarily spend on the house and, on the essential goods. And so a lot of this money is discretionary, and we've seen quite a remarkable rebound in discretionary spending in Q3 and now Q4. Albeit, I think in the last month we've seen a bit of a concerning slowdown.
Mm-hmm.
And I think the third element is just lack of travel. We did have to lock down the country, and there's no specific scientific numbers, but in my reckoning, the Saudi population spends somewhere between 18 and 20 billion per annum abroad. They couldn't this year, so a nice chunk of that money was spent locally. So
that's why our economy has gone so badly, is because we don't have the Saudi summer reals coming into London.
Yeah, please come back, Ammar. Don't do it next year. We need you here.
No,
Seriously.
I don't think we'll be barred from travel for too long anymore. I think now that we have a vaccine, I think the world will come back quite quickly.
Well,
so
let's hope so. Now, Simon, come back to you on this one. But one of the characteristics of Saudi's sort of G20 peers, at least many of them, not all of them, but many of them, say for example the European countries particularly, was a considerable role of government in economic stimuli, in monetary policy loosening, as such as it could do, in the UK, the furlough system, all of that. Saudi Arabia, and our friend who we've had on this program, Ammar Alkhudairy, put VAT up by 200% at the beginning of the pandemic. It went in the other direction. Now, that's not to say there wasn't support through SAMBA and various other entities, but the focus on the revenue side of the government income and expenditure account was quite spectacular. What was your view? Do you think that was, did you expect that to happen? Do you think it had the effect that the ministry intended it to, in terms of keeping the revenue picture of the government relatively stable, whereas in previous years it wouldn't have been?
I will answer just to come back briefly to Ammar's question on where we got the forecast wrong for this year. I think he's right that the downturn did turn out to be less marked than we'd feared at the worst. But I do think it's important to just look at the breakdown of those GDP numbers, and it's domestic demand. That's what really makes a difference to corporates on the ground. Those domestic demand numbers, the drop is steeper than the headline GDP. Not out of pace with the rest of the world, and not surprising given what Ammar rightly describes as the twin shocks of COVID and oil. But that drop was real, and I think it will take quite some time to get through that. I also think he's absolutely right on the impacts of rising levels of female labour force participation. I was just looking, last 2 years there are 500,000 more Saudi women working than there were back in 2018. This is a remarkable shift. In terms of policy, well, I guess you've got three prongs to that policy response. The success in containing the virus itself, and I was looking through I think it's the Arab Youth Survey, and it has perceptions of governments as a consequence of their management of the virus. And Saudi really stands out in terms of the trust that was shown by the population in government, because it was so effective and so successful in bringing the virus down and preventing a material second wave. And obviously that has direct consequences for economic behavior as well. You're not going to go out and consume goods and services if you're not confident it's safe. And I think success in dealing with the virus has helped to support activity. I think monetary policy has been very, very supportive and very effective. If I look at Saudi, not just the rate cuts but also the targeted support that SAMBA offered through the commercial banks to the domestic economy, to those vulnerable sectors of the economy in particular, it worked. And I contrast, I don't know, credit growth of the private sector in Saudi, well, against pretty much anywhere else in the region, the UAE, for example. In the UAE, private sector credit in the UAE has been contracting month on month for the last 2 or 3 months. Huge increases in liquidity, but it's all gone to the state. In Saudi, monetary policy was very successful in both supporting the government during a period of heightened fiscal pressures, but also ensuring that there was support that went to the private sector as well. I think that has helped to soften the downturn. Certainly, the housing programs that Ammar was describing have been a big part of that. The third element, fiscal policy. You're right; it has been more cautious and perhaps more defensive. There were some significant above the line fiscal support measures that the government introduced. But if you look at the IMF measures that compare those levels of support globally, it's clear that was offered in Saudi and in the rest of the Gulf was lower than elsewhere in the world. And if you look at actual spending numbers for the first 3 quarters of this year, spending is down 4 or 5% on where it was last year. Capital spending is down more sharply still. And on the other side of the balance sheet, and the increase in taxes, you're right, that hasn't happened anywhere else in the world. It has meant that the support fiscal policy could offer has been much more limited. Do I think it was right? Well, I think it was necessary. I mean, Saudi Arabia is not managing a problem that began with COVID in 2020. Those public finance pressures have been building since 2014, and the oil price dropped. Then we've seen public debt rise over the last 5 or 6 years. I think Saudi's run an average budget deficit, saying almost 10% of GDP since 2014, and the additional shock of COVID left policymakers with a very tough choice. And the choice they took was to deal with that shortfall and deal with it firmly. My hope and my expectation is that this isn't just about one-off austerity. This is about a longer, broader program of fiscal reform, which will fundamentally rebalance public finances in the kingdom, that will both bring spending more closely under control, will put an end to those periods of rapid pro-cyclical spending in other eras of high oil prices, but it will also start to broaden the revenue base as well. And for me, an expansion of the tax net is an essential part of that process. So it's not easy. I think policymakers have faced tough decisions. It's not about 2020, but it's in the context of the last 5 or 6 years. I don't think it's a one-off, and certainly the preliminary budget statement, it gives you every reason to expect another year of prudent fiscal planning for 2021. But I do think you've got to see it in the context of what happened with monetary policy and the broader health program that the kingdom so successfully oversaw.
Yeah. I mean, it wasn't. I didn't want to give the impression that it was only austerity, but what I think, and Ammar, I'll come to you on this again, because as our representative in Riyadh, you live this every day. But if you look at the numbers of, say, the last 2 previous shocks, the oil price shock of 2014 and the financial crisis in 2008, what happened? So, government spending plowed on, or was in some cases even increased a little bit. Taxation wasn't introduced. There was very little debt issuance, if on the international markets, none at all. And the hit was to SAMBA reserves. This time round, yes, SAMBA reserves are down from where they were in January, but then you have to factor in also that there was a $40 billion transfer from SAMBA to PIF. And once you factor that in, they're basically flat. And my question finally, Ammar, to you is this time different? It seems to me as if this shock is being treated, managed in a very different way to previous shocks.
If I may say, everything in this country is different today.
Well, that's true.
Everything, okay? I mean...
but it's still hot in the summer.
If I may say, the way we approach challenges and problems and decisions, whether it be 6, 7 years ago or 14, 15 years ago, I think the tendency was to solve for 2-3 quarters, maybe 1 year, maybe, you know. Today, the leadership tends to look at way longer term, and they they do a lot of deliberate analysis, and so yes, you could say, for example, the VAT. Why now? Well, because somebody sat down and did some very hard thinking, balancing between the credit rating of the country, the liquidity of the country, its ability to maneuver, not just in 2020, but 21, 22, 23. So I think the way we're approaching the whole decision-making process has changed. So to your question, yes, it is very different this time.
I mean, it really feels that to me. There are some questions that that have been asked that I'd like to put to actually to both of you. So Hansa Mzibat, Hansa, I apologize if I mispronounced your name, says these 800,000, Simon, you said 500,000 women have a higher salary as the expats they've replaced. So I mean, what I think the question is there is the impact of this workforce labor market change pro economic growth. Ammar, I'll ask you that question.
Me or Simon?
Yeah, it's a hard one, Ammar. It goes to you.
Okay, yeah, I'll do it. What you have to think about is economic efficiency and multiplier effect. Okay, so the cost of doing business in this country has increased quite significantly over the past 4 or 5 years, without a doubt. It has been a painful transformation, but it's a necessary transformation. We had a situation that we had a regime, an economic structure which was concocted back in the 70s that enabled free flow of labor and restricted flow of capital, which is quite counterintuitive to any open economy that wants to grow. At the time, it made a lot of sense because we needed labor to build the country, because the country was just not built then, and we didn't need capital. We wanted to nurture our own capitalist merchant class or middle class. Situation has changed. We're now a G20 country. We're mature. And so you cannot continue to have free flow of labor, restricted flow of capital. You need to reverse that, which we've done. And once you restrict the flow of labor, of course, the price of doing business will go up. But the upside of that, for people who thought that this is an unfair pain inflicted on businesses, as they might have 2-3 years from now, today the proof is in the pudding. With 800,000 women or so, plus or minus, in the workforce, our economy is much more resilient. Yes, they do get paid more than expats, but guess what? They go and buy things with them here. They go out to dinner. They buy the next bag. They consume, and so the economy, the price of doing business has gone up. The actual effect on the economy, in my opinion, has been very positive.
There are lots of questions on banking, including from Henry Azam, who I must think is the Henry Azam, who wrote Euromoney's first Saudi Arabia book back in '95. Henry, I'm not sure if I got that right, but I remember reading it when I joined Euromoney, when dinosaurs still roamed the earth. We're going to come to banking in a moment. What I want to do quickly there is to just look at next year and the year beyond, and look at oil. Simon, we talked a lot about what Saudi has done and is doing itself, but and yes, it does have a very significant influence on the oil price, but it is no longer the swing producer that it was. What is HSBC's view on oil and the oil market in 2021, 2022? Do we see both the demand, the volume demanded, and the price recovering, and if so, to what sort of levels?
I've learned to be humble enough not to try to avoid giving a spot number for the oil price. What I can give you though is a trading range, and I'll publish view for next year in 2022 runs off oil trading a range of 45 to 55 over the next couple of years. It may spend a little time below that price. It may spend a little time above that price. I think over the next couple of years, you will see it probably rise on average within that band. I struggle to see oil being higher on a long-term basis, and because I think demand is going to struggle even in a post-COVID world. I think the environmental concerns are going to have an increasingly significant impact on oil's role in the energy mix. And supply side, you're right. I mean, there's an abundance of conventional, certainly non-conventional energy sources out there. So to me, it's a $45 to $55 a barrel band that will dominate over the next couple of years. At the moment, it feels like the risks are to the upside rather than the downside to that number. But I don't think they're massively. I don't think it's massively skewed that way.
And how important is the sort of unity amongst, or semi-unity amongst OPEC plus? I mean, should we be watching that then like a hawk to see whether the Russians and the Emiratis and the Saudis are all still talking to each other?
Been absolutely critical this year. I mean, it's only 6 months ago that the Canadians couldn't give away oil. They were paying people to take oil because the price was so low. It's been discipline. Exactly, it was discipline on the supply side that's allowed oil to come through this year, and I think continues to frame the outlook for the next couple of years as well. Again, I track it from meeting to meeting, track the announcements as closely as I can. That it feels like we're walking into a world where some of those supply restrictions can be eased as demand picks up. And as Ammar said at the beginning, that matters because revenue in Saudi isn't just about price. It's price times production, and it has been Saudi that's been carrying a lot of the burden through the course of this year.
Ammar, what's the SAMBA view on oil, and does it align with the preliminary numbers from the government? I don't know whether the government have announced they never really announce it, but one can sort of reverse engineer it.
No, we can always extrapolate the number from the budget, but we don't have that visibility yet. But it is extractable from the budget. It's going to get less so as now the government has finally, mixed its share, its revenue sources. But we can still decipher it. But in terms of our view as SAMBA, we're very much, I think, aligned with what Simon has said. 45 to 55, I believe. I mean, if you look at airliners, for example, they consume something like 7 to 8 million barrels a day in normal circumstances. I doubt that's going to go back to more than 4 or 5 in the next 12 months on a year average. And so there's always going to be this overhang of productivity. I believe over the next 2 to 3 years, we will see more and more production disappear as some wells, become unusable, decrepit. People's inclination to drill more holes is obviously stymied right now. So what is going to take a more significant movement of price of oil is a different supply-demand touch point than what we have today. And that probably takes 2 to 3 years, Simon, I would say, before you could, before maybe the world will settle at 85 million, 90 million barrels instead of 100. Yeah. And then supply would also drop as much.
I'm comfortable with that as a view as well. I mean, again, the experience of this year, the year before, and many years before that keeps me cautious when I'm trying to pin down the exact number. I do think it's helpful to think in terms of ranges over a cycle, but that feels like the kind of environment that we're in. What feels very unlikely is a return to the kind of world that allowed the Gulf as a whole, including Saudi, to enjoy those big booms of the past. The boom of 2004, 2014, that doesn't look like it's coming back anytime soon anymore. And the boom of the 70s, 80s is coming back anytime soon. And I think it's just critical that's the starting point that the policymakers begin with when they're thinking through not just how they want public finances to develop over the next few years, but how they expect to construct a growth model for the next few years as well, because that period of the oil booms and the spending surges that come off it, I think that's in the past.
Yeah, well, I think general acceptance of that.
If I
Sorry,
may, I agree completely. At a point in time, a few years ago, the world consumed 94 million barrels, 95 million barrels at $100. That's not coming. It's either going to be, if you want $100, then it's going to be 70 million barrels, metaphorically, right?
Yeah.
If it's going to be 100 million barrels, it's not going to be $100. So the balance of how much the world economy spends on energy has changed, permanently shifted downwards.
Good. Well, as always with these things, we've only ever answered the first couple of discussed the first two topics of about 7. So I need to crack on. But there's just a couple of questions on expats. I was going to talk about this at the end, but while we're talking about structural changes, Ammar, you've touched on it. Ammar, this is to you. So what you're really saying, I think, is that the reduction in expatriate labor, migrant labor, whatever, into the kingdom is permanently reduced. It's not going to go back up again as and when the economy starts to grow vigorously again. This is a structural shift rather than a demand-driven change.
Absolutely. Absolutely.
And as we've already discussed, sorry, I'm trying to speak and answer questions, walk and chew gum at the same time. So that's good. Let's go on quickly to the capital markets. This is Euromoney. Can't have a Euromoney session without talking about the capital markets. One of the standout things this year was Saudi came to the bond market twice. Once right in the teeth of the pandemic with its longest ever bond, which I think was 40 years or something. I mean, so quite impressive. Simon, to you, will the capital markets remain as hospitable to the Saudi sovereign and by association to sub-sovereign fake corporate issuance in 2021, 2022?
Well, yes, I thought so. Certainly, obviously it will depend what happens with global risk appetite. At the moment, it feels pretty supportive. That can obviously change, but I think there's a recognition of Saudi's underlying sovereign balance sheet strength. That's widely recognised. I think there's a recognition now globally of the kind of reform program that Saudi's delivering on, and I think there's also an understanding of the genuine improvement there's been in economic management over the last 3 or 4 years. Saudi's not a novelty on the capital markets anymore. It's well known. It's part of the mainstream. It's known by EM, but also by DM investors looking for high grade assets. So at the moment, it feels like a supportive environment for the kingdom. Obviously, things need to continue to move in the right direction. I think that continued access and ready access isn't just about what happens externally. It's about the kingdom continuing to deliver on that consolidation program, because I think there's been the argument over the last 3 or 4 years has been, whatever the flow problems Saudi may be facing, the stock position is really strong. As a consequence, credit strength has a firm foundation. The longer this goes on, if we go through another few years where those deficits continue to be very big, you begin to see that balance sheet pressure grow, then perhaps market perceptions would change. That's not the environment that I think we're walking into. My forecast of the budget deficit narrowing next year and in 2022, I've been impressed by what's been delivered by policymakers this year, certainly in terms of fiscal consolidation. I expect that to continue over the next couple of years. As a consequence, I think the rating agencies and the broader market will continue to look on the kingdom pretty favorably.
Excellent. Ammar, also, you are chairman of one of the most important banks and soon to be chairman of the combined most important bank in Saudi Arabia. You are both an investor and a potential issuer of fixed income globally. What's your view on how the international capital markets have changed their view on the kingdom? And do you think, as Simon does, that other things being equal, that will remain as we go forward?
I think we have done 3 things in the past 4 or 5 years, which are very important. Number 1, transparency. We had significant opacity of the balance sheet of the balance of payments, of so on and so forth. I think today the Debt Management Center and the Minister of Finance provide a level of disclosure at a frequency that is certainly light years ahead of where Saudi was, and perhaps quite in line, if not ahead of many of the G20 countries or OECD countries. So transparency is one very important element. The second important element is, how do you behave? Do we have resolve? Do we have a conviction in fiscal discipline and in taking the painful pill in a timely manner? And I think what happened this year in terms of budget cuts and in terms of what we did with the VAT has shown that the country is willing to take the necessary antibiotic or whatever pill you need to take to
mRNA, isn't it?
mRNA to address the particular ailment that you have. I think we've shown incredible resolve and willingness to do what is necessary. The third element is engagement. Again, I chapeau to the Debt Management Center, because you know, in the old days, you think about doing something in the market, and then you start talking to people, and then, you know, 3 months later you change your mind or something. If you look at how much time now the senior leadership of the center and of the Ministry of Finance spends engaging with international investors, with the capital allocators, to explain to them what is happening in Saudi, because a lot of it is about knowledge, right? I mean,
yes, absolutely.
Honestly, we have nothing to hide. We just need to tell people how it is. And I think we've made great strides on all these three fronts. And because of that, I agree with Simon. I think there is very good appetite for Saudi capital markets going forward, including, by the way, the equity market. If you look at the inflows that are happening, this is obviously caused not just by Saudi, but by what's happening in the emerging markets and how much money is being poured into emerging markets. Literally on a weekly basis, we're getting some significant inflows of capital into the Saudi market, the equities.
I mean, I think Fahad at the NDMC, who was awarded our sister publication, Global Capital's, DMO of the Year, completely justified in my opinion. Former employee of your shop, Simon.
Was that a question or a statement, Richard?
That's a statement. I was just checking you're still awake. You hadn't been replaced by a picture. But the point I'm trying to make is, this year and last year we've really built the yield curve by getting these longer tenors. But do you think it's viable that there might be issuance in other currencies? We have a question in that will the kingdom look to issue outside the dollar and the rial market? Simon first, Ammar second.
No idea. And again, I'm public side. I've got no idea what the plans may or may not be. But I've certainly seen other EMs do so. I'm sure if the pricing was right and the appetite was there, it would be something that Saudi, like others, would consider. And just to Ammar's point, in terms of disclosure, the idea of having a preliminary budget statement, a quarterly fiscal data. We had flash Q3 GDP. I think about 6 weeks after the quarter ended. I've been working on Saudi since the mid 90s. We used to wait months, years for data. It is a remarkable shift, and again, I think it's part of the reason why it's easier to talk to the outside world about the kind of credit risk that Saudi genuinely represents. And just very, very briefly, in terms of the equity market development, what obviously we're in the index, and there's a liquidity there that certainly the outside world finds appealing. What I'm really hoping is that as part of this next phase of the reform program, perhaps accelerated by the economic stresses and funding needs that this year has brought, one of the things that you'll start to see is a bigger role for domestic equity markets as a means to raise funding raise funds from onshore and from offshore. I hope it becomes an accelerant for the divestment program that's begun, but which clearly has a long way still to run, because those are the kind of developments that don't just bring more funding in. They start to create a framework where you get market discipline for the allocation and pricing of capital. And to me, I find it difficult to create a very strong near-term recovery story. I don't think in a fiscal environment like this one, that's what we're going to get. And frankly, I'm glad that that's the case, because I've seen these sugar rush growth phases before. What I'm looking for, what I'm expecting to see rolled out, is that longer term program that can shift the drivers of growth and can begin to take sustainable growth, trend growth, potential growth to a level which is higher than is currently the case, and that can satisfy the needs for goods and services and infrastructure and housing and employment the kingdom's own young, fast-growing population needs to see met.
Thank you. I'm going to sort of slightly change the running order, chaps, because we've got lots of questions, and I want to try and sort of group them together into themes. So the first question, and this is directed particularly at you, Emma, although Simon, do feel free to comment, is bank mergers and acquisitions, that type of thing. So for the context of the three people who are in our audience, the tiny percentages that don't know what happened, NCB, largest bank in the kingdom, merged with SAMBA. Ammar is going to be the chairman, I think, of the new combined entity, which is congratulations or bad luck or whichever one it is. But Saudi Arabia had underscaled banks. Our friends in the Emirates had banks over 200 billion of assets. NCB now is SAMBA's 220, something like that. So you've got one, what I would call regionally scaled bank. Do you see there being appetite for further mergers in the sector, particularly perhaps in these sort of more pure play Islamic banks?
Yeah, you mentioned our size versus the size of this bank and that bank, and if I can just take a pause and look at the whole thing from a different perspective, because that sounds a little bit like, I need to be in the league table or something like that. Let me give you just a very down-to-earth check on the most fundamental reason why we are doing this transaction. So I have a study, and I've had it in my drawer for quite a while, which shows we looked at over 100 banks globally in emerging markets to see the correlation between market share and ROE, profitability.
Yeah.
And the correlation is compelling. It's it literally, everything falls on this line, very few outliers, and the difference between 30% and 20% market share, I cannot recall the exact number, but it's roughly speaking 500 basis points of ROE differential. So size matters. It's not just for boosting rights. It's not just so that I'm on the league table. It allows me to make way more money. Mm-hmm. So offensively, it matters. I become more profitable. Defensively, it matters maybe even more. I have enough oomph to spend on technology, on defending against fintech and digital banking and all of that. Banking is in a way a commodity industry, right? You're dealing in dollars and reals, and you can transport them free of charge. They're literally equal in size and smell and taste, whether you take them from me or from Arab National or from Rashi Bank. So it's a commodity. And so you really need to be super efficient. So the primary, the people need to understand this is good for the shareholders, and it also happens to be very good for the economy and for the ranking tables. I just want to reprioritize.
And what about customers? Are they good for the customers as well?
This is a challenge that the two chairmen have really, Saeed Al-Hamdi and myself have spent a lot of time in the past 2 months, and will continue to do so until our legal day one, which we expect to be in the early second quarter of next year. We've spent a lot of energy to come up with a plan, primarily driven by Saeed, I must give him credit, to make the client experience pleasantly surprising, because people are afraid, is it going to deteriorate, etc. The best they can hope for usually is no deterioration. What we're going to try to do is actually make them say, wow, this is, better than what we expected. And some of that comes with technology. You launch certain services, you launch certain applications as you're just about to merge, and make life simpler and more seamless for people.
Well, I wish you every success. So we could talk about this all day. Maybe we can do another one next year and go into more detail, because it's a great story. It's been a long time in the cooking, and our congratulations to you. Simon, I'm going to ask you a question that Ammar didn't actually answer, but he sort of got close to it, which is, do you think there will be more in the kingdom?
More what?
More bank mergers?
No idea.
No idea. Fair enough. Okay, let's move on from banking. That's answered that question. Let's go into the long term, and particularly into Vision 2030. When Vision 2030 was launched in 2016, some of us, and I think I probably include myself on in that list, were a little skeptical about some of the things that were planned, and that Saudi really hadn't had the experience of delivering anything of that scale and complexity, nor indeed really had anybody else. So we sort of were genuinely very happy that this project had been embarked upon, but perhaps less certain that it was going to achieve all of what it set out to achieve. I'm very pleased to say that to a large extent, we have been proved, or I have been proven wrong, that my skepticism was misplaced, and that many of the first phase of initiatives, particularly in the FSDP and in housing, as you mentioned, Ammar, have been achieved. And our congratulations, and it's better than brilliant news. Kingdom needed it, helped them through this year. However, arguably, the next phase is more difficult. This is about the delivery of mega projects, giga projects, as they seem to call themselves, and also the retooling of the economy towards service sectors like health, education, and tourism. So Simon, I'm going to come to you on this one. You talked a little bit about CapEx being down, expenditure being down. Do we have anything to worry about in terms of the delivery of the next phase of 2030?
I'm a balding middle-aged English economist. Don't ask me if there's anything to worry about. Of course, there are things to worry about, but I think you're right. You've got to recognise how much things have changed over the last 4 or 5 years, and I put some of the social reforms on top of those other measures that you identified that do make the kingdom feel like a very different place, a very different place to do business than was the case not so long ago. I'll leave the giga projects to Ammar, but I think one of the things that we've been talking about, we've written about at length in our published research, is the region as a whole, including Saudi. These are old problems that the kingdom's kingdom is facing up to. Problems that go back, as Ammar said, back to the 1970s, but they're being addressed with a new urgency. And I think some of that for the next few years will be about leadership and about the plan. But I think you must also recognise that the losses of this year and the shock of this year should be a real accelerant for the kind of reforms that don't just fix public finances, but begin to change the incentive structures, if you like, in the kingdom that can bring with it an improvement in productivity. And I think labour market changes are a really good example. I think I was absolutely right in terms of higher cost labour is not an obstacle to productivity growth. In fact, I'd argue that one of the problems for the private sector, one of the reasons why private sector productivity growth has been so low over the last 50 years, is that there's been no incentive to invest in techniques, in technology that could boost the productivity of labour, because that labour has been basically free. That's now changed. Suddenly, corporates have to find a way to use that labour more efficiently, and I like this. What I'm also expecting, though, is the pressure on public finances to feed through into public sector employment, because as well as that gap between local and expat pay, there's also a big gap between average pay in the private sector, average pay in the public sector for nationals as well as for expatriates. That's going to narrow, I think, because the pressure on public finances means that you won't get the same increases in the volume or in the average wage inside the public sector, and that creates real push incentives for nationals to not be looking for work in the public sector, but for the private sector. When they're there, suddenly you change incentive structures for them to acquire the skills and the education, the backdrop to take risk and be successful in that private sector. So for me, the changes of the last while have been good. You're right that the challenges for the next phase are harder, but what I'm looking for is the pressure of economic necessity being as effective a driver of change as the pull of good intentions and visions for the future. And that's why, if I'm honest, I'm hoping my oil price forecast doesn't get too rapidly overshot, because I think that pressure continuing to be there gives policymakers scope to make gives them an explanation for the tough choices they have to make, and hopefully means that reform program can continue to build, because without that kind of structural reform, potential growth in the kingdom is still not high enough to meet the demands of the population. And that was covered in 2014 by the oil boom and the spending surge. But you take that away, you look at trend growth over the last 5 or 6 years, and clearly it's been struggling to gain. And that's why this period of change is so critical. Why the change of the last few years are so encouraging, but why you're right, that needs to continue and build speed in the years ahead.
Thank you, Simon. As always, incredibly erudite and interesting summary of the whole economic imperative, plus and minus. Ammar, I do want to sort of get to these giga projects. I've got some questions here. Claudia Franks is saying, will international tourists really come to Saudi Arabia? Is the kingdom ready for them? These are grand projects, big visions, big providers of employment, and they have substantial capital expenditure needs. Do you see them as important as perhaps I do? Or are you more prosaic like Simon? And do you think that they will proceed unabated despite the challenges of the pandemic?
The amount of liquidity sloshing around the planet these days is astounding. It's just unbelievable how much money is chasing pittance of returns. And we see it. I mean, you see it in, I pity those who sit on the investment committees of pension funds in Europe or in the US, and how in the hell they're going to, match their actuarial requirements. So there is a lot of money on the planet. If we, I believe, like we did with the debt management, if we go out proactively, find out what turns on this capital to allow it to come to Saudi Arabia, rather than, in the capital market, which is in the debt capital market or in the equity capital market. But what is it going to take to get them to do direct investment? What is it going to take to do even through funds and other mechanisms, so that you bring in non-developer capital, but regular capital, pension fund type of capital? If we go out and actively engage with these people and find out what tweaks we need to do to the ecosystem to bring in that money, I think we will find the money. If we continue to think that it's only the government that is able to do this, well, if you look at the greatest economies in the world, with the possible exception of China, but I'm not even sure China is an exception, it is the private sector that grows economies. It is the private sector that provides sustainable growth. The government kickstarts it, as we've seen with the Asian tigers the first few years. The government needs to initiate, but at the end of the day, it is the private sector And so I believe these giga projects, if we provide the right ecosystem, we will find capital, whether it's international capital or local capital. I mean, if you think about how much Saudi money, private Saudi money, is in, Swiss bank accounts and things like that, if we give them the right story and get them to bring back some of that money and some co-investment, I think we can actually get these projects done. Maybe not in the same, instead of X number of years, it will be X 1.3X or 1.5X number of years, but it's doable.
Yes, I remember quizzing various senior Saudis about the timeline. They said, look, if we get half as much done in 1.5 the time, that's still 10 times as much as we've ever got done before. So just be real. And I think it's important that we give everyone the benefit of the doubt. I'm sure, like me, Simon is looking forward to holidaying on the Red Sea in a year or two.
Looking forward to going anywhere at the moment, but I think Ammar is also right that what you're looking for is an environment where, I think, danger is when you've got all that money sloshing around. The risk is that it doesn't get used efficiently and well. And I think one of the real lessons, if you look at the surge in Asian growth during that period of rapid industrialization and development in East Asia, the critical part of industrial policy was to ensure that there was discipline and a framework which focused on the return on capital as a means to price it. And I think when I'm thinking about those the giga projects, that's always what I'm looking to see. Is there something there which effectively, which allows the market to assess risk and prices capital accordingly?
And that's why I'm hoping, to Richard's point when he said, with the drop of revenue, etc., will that compel the government to, be in a mode of partnership with the private sector, more so. And I'm hoping that would be the case, not just because we need the private sector money from the government point of view, but to Simon's point, because once you do it, both government and private money, then these, the efficiency of capital, the return, etc., become very important and become, it keeps the whole system honest, right? You're not gonna, if you've got private sector investors with you, you're not gonna do something that has a risk reward profile that makes sense on some other measurement criteria. So I'm actually optimistic that, and I hope that the government will engage the private sector, whether it be Saudi or international private sector, private investors, into this process, because it will, by definition, reprioritize some of these projects into more of a what makes more financial sense, or what makes more economic sense.
Well, I could go on talking to both of you all day, all week, and I feel that we've only really scratched the surface of this. I've got buckets more questions, but time is, as always, our enemy. It is 1 minute to 2 in London, and we need to bring this to a close. So, first of all, huge thanks to Ammar and to Simon for being with us today. Really appreciated you. Fascinating. I hope it's been interesting for you.
Very much so. Thank you very much.
Thank you.
It's a pleasure. As I say, really genuinely a pleasure to be able to work with you at this end of the series. I need to thank our partners at the Ministry of Finance for their support throughout the season, their input and paying attention to this. They've been great, as always. To our sponsors, NCB Capital and SAMBA, and of course HSBC. We wouldn't have been able to do this without you, so thank you for that, for being there.
A few months ago, I would have been insulted for you bringing up NCB Capital before SAMBA, but now I don't care.
Well, I think they paid more than you. They paid more than you at this. We're for sale. If you want SAMBA to go first, just retrospectively, we can edit you in the previous ones on demand. The future's virtual, as is the past. But in all seriousness, thank you to them. I want to thank all the team at Euromoney. We set this season up. We started this live streaming thing in April, 1 week after lockdown. We've done it every week since. and the teams are still working from their homes. It's been an amazing effort, and hats off to all of them. This is the final one in the Saudi series, the Saudi macro series. We are still talking about housing finance for Saudi Arabia. We've got 2 more of those. So the next in the season is my friend and colleague Victoria. Will be interviewing Luca Bertolot, who is the Secretary General of the European Mortgage Federation and the ECBC European Covered Bond Council. So a big figure in the housing finance market in Europe. We'll be talking about what's going on in Europe and how the model of covered bonds might be applicable to Saudi Arabia. That will be a week today, December 14th at 1400 GMT. And you can also catch up with the end of that series, which will be on the Thursday, which will be myself and our Asia editor, Chris Wright, talking about the outlook for mortgages in the Saudi Arabia next year and beyond. So 2 more before Christmas, before the end of the year. But until then, I want to wish all of you, our audience and our participants, a very good afternoon. And thank you very much for joining us.
Thank you very much, Richard.
Thank you,
Simon.
Thank you, Ammar. Cheers, Richard.
Merry Christmas to both of you.
Yeah, and well, I suppose the same to you.
Bye-bye.
Bye-bye.